If you walked past the Bank of England on September 16th, 1992, you would have seen a fortress, 300 years of stone and history, the institution that financed wars against Napoleon, the institution that once controlled the currency of a quarter of the globe. Most people believe the British Empire fell because of military defeats. They think it was submarines or independence movements or the cost of world wars. But that's not the whole truth. The British Empire didn't just lose territory. It lost something far more fundamental. It lost control of its own money. And on that Wednesday in September, a single trader in Manhattan proved that the might of an empire means nothing when the ledger doesn't balance. His name was George Soros, and in 24 hours he made $1 billion by betting that Britain was lying about the value of its currency. The Bank of England was not just a building. It was a cathedral of capitalism. Inside those walls, men in tailcoats had managed the flow of gold that built railways across India and financed the defeat of Hitler. The pound sterling was not just paper, it was identity. It was the physical manifestation of British credibility. When a British diplomat spoke, the world listened because behind his words stood the pound. When a British banker signed a contract, it was honored because the currency was sacred. The entire system rested on one principle: trust. The world had to believe that one British pound would always be worth what Britain said it was worth. But by 1992, that belief was becoming a lie, and George Soros could smell it. To understand how a hedge fund manager broke an empire, you need to understand the trap that Britain had walked into. In the late 1980s, Europe was drunk on optimism. The Berlin Wall had fallen. The Cold War was ending. Politicians across the continent dreamed of a united Europe that would never go to war again. They created a system called the exchange rate mechanism. The idea was simple: lock all European currencies together like a chain gang. The French franc, the Italian lira, the Spanish peseta, and the British pound would all move in sync. They would be pegged to each other, anchored to the strongest currency in Europe, the German mark. Germany was the economic superpower. Its central bank, the Bundesbank, was legendary for its discipline. Germans remembered the hyperinflation of the 1920s, when people burned money for heat because it was cheaper than firewood. So the Bundesbank kept the mark strong and interest rates high. Other countries wanted to borrow that credibility. They wanted the stability of Germany without having to earn it. Britain joined this system in October 1990, under pressure from politicians who believed it would cure Britain's chronic inflation. Prime Minister John Major was a true believer. He set the exchange rate at 2.95 German marks to 1 British pound. He promised the world that the pound would never fall below 2.77 marks. It was a sacred line, a promise written in ink and backed by Britain's reputation. But the system had a fatal flaw. It assumed that what was good for Germany would also be good for Britain. It assumed that all of Europe would need the same economic medicine at the same time. That assumption was about to shatter. In 1992, Germany was dealing with reunification. Absorbing East Germany was expensive. The government was spending billions to rebuild crumbling roads and factories. To prevent this spending from causing inflation, the Bundesbank did what it always did. It raised interest rates. High interest rates cool down an economy. They make borrowing expensive. For Germany, this made perfect sense. But for Britain, it was poison. Britain was not booming. Britain was drowning in a recession. Unemployment was rising. Homeowners were defaulting on mortgages. Factories were closing. When your economy is dying, you need low interest rates to stimulate growth. You need cheap money flowing through the system. But Britain couldn't cut rates. Because of the exchange rate mechanism, if Britain lowered rates, investors would sell pounds and buy marks to chase the higher returns in Germany. The pound would fall. And under the rules of the system, the pound was not allowed to fall. Britain was trapped in a golden cage. To stay in the European club, the government had to keep interest rates painfully high. They were sacrificing their own people on the altar of an exchange rate that was completely artificial. The British economy was screaming for oxygen, but the politicians had tied their own hands. Think about the scale of that contradiction. You have millions of British citizens losing jobs and homes because the government is more worried about impressing European bureaucrats than helping its own people. The system was unsustainable, and George Soros was watching. Soros was not a typical Wall Street trader. He was a philosopher before he was a financier. Born in Hungary, he survived the Nazi occupation by using fake identity papers. He learned early that authority figures lie and that systems collapse when reality diverges from the official story. He developed a theory called reflexivity. In simple terms, markets are not rational. They are made of people. People believe stories, and when the story becomes too disconnected from reality, the whole structure implodes. Soros looked at Britain in the summer of 1992 and saw a massive gap. The story was that the pound was strong and stable. The reality was that the British economy was on life support, and the only thing holding the currency up was interest rates that were killing the patient. Soros sat in his office at Quantum Fund with his chief strategist, Stanley Druckenmiller. Druckenmiller was a genius at reading macroeconomic pressure points. He told Soros that Britain was like a man holding his breath underwater. He could do it for a while, but eventually he would have to come up for air. Eventually, Britain would have to cut interest rates, and when they did, the pound would crash. The beauty of the trade was asymmetric. If Soros bet against the pound and he was wrong, he would lose almost nothing. The British government would keep the currency stable, and he'd pay a small fee. But if he was right, he would make a fortune. It was a bet with limited downside and infinite upside. A one-way ticket to wealth. But Soros wasn't alone. Across the world, traders were circling like sharks smelling blood in the water. The Italian lira was the first to crack. In early September, Italy tried to defend its currency and failed. The lira was devalued. This was the signal. If Italy could fall, so could Britain. The trigger came on Tuesday, September 15th. The president of the Bundesbank, Helmut Schlesinger, gave an interview. He was careful with his words, but he hinted that some currencies in the system might need to be realigned. He didn't say the word pound. He didn't have to. Everyone knew what he meant. The German central bank was not going to fight to save Britain. He was giving the market permission to attack. It was a green light. When that interview hit the news wires, Druckenmiller walked into Soros's office. He said they should increase their bet against the pound. They already had a position worth about $1.5 billion. Druckenmiller suggested maybe $3 or $4 billion. Soros looked at him and said something that became legend on Wall Street. He said, "If you're right, you can't be a little bit right. Go for the jugular." Soros told him to bet everything. Leverage the entire fund. Sell $10 billion worth of British pounds. That night, Quantum Fund went to war. They called banks around the world, London, Tokyo, New York. They borrowed British pounds from anyone willing to lend. Then they immediately sold those pounds for German marks. This is called short selling. You borrow something you don't own. Sell it at the current price. Wait for the price to crash. Then buy it back cheaper and return it to the lender. The difference is pure profit. By the time the sun rose over London on Wednesday, September 16th, a tidal wave was building. Soros and dozens of other hedge funds had created a mountain of sell orders. They were dumping pounds faster than anyone could count. Inside the British Treasury, Chancellor Norman Lamont was woken by a phone call. The news was bad. The pound was already falling in the Asian markets. Lamont was the man responsible for defending the currency. He drove to the Treasury building in Whitehall. The atmosphere was tense. They had a war chest of foreign currency reserves worth about $40 billion. The plan was to use that money to buy up the pounds that Soros was selling. If they bought enough, they could stabilize the price. It was a strategy that had worked before. Central banks are powerful. They usually win. But they had never faced a market this aggressive. At 8:30 in the morning, the London markets opened. The Bank of England immediately intervened. Traders at the bank began buying pounds in chunks of hundreds of millions. They were shouting buy orders down phone lines, trying to project strength. Usually when the Bank of England steps in, the market pauses. Traders get scared. They don't want to fight the government. But on this morning, the market didn't pause. For every £1,000,000 the bank bought, the hedge funds sold 2 million. Soros was selling. Other funds were selling. Major corporations like Ford and BP, seeing the pound collapse, started dumping their own reserves to protect themselves. It was a stampede. The Bank of England was burning through its reserves at a terrifying rate. Imagine trying to hold back the ocean with a bucket. That's what they were doing. They were spending taxpayer money, billions of pounds, and handing it directly to George Soros. By 10 in the morning, it was clear that buying wasn't working. The pound was pinned to the floor of its trading band. It was hovering just above 2.77 marks. If it fell below that, Britain would be in violation of the treaty. Lamont and his officials held an emergency meeting. They realized they had to escalate. They had to use their nuclear weapon, interest rates. If buying the currency didn't work, they had to make the currency irresistible to hold. They had to raise interest rates so high that speculators would want to buy pounds to earn the interest. At 10:30, the Bank of England announced a shock rate hike. They raised the base rate from 10% to 12%. A 2% hike in a single day is almost unheard of. Lamont hoped this would send Soros running for cover. But the market laughed. The traders looked at the rate hike, and they didn't see strength. They saw panic. They saw a government in its death throes. They knew the British economy was already weak. They knew homeowners were already drowning under 10% mortgage rates. Raising rates to 12% would cause riots. The government couldn't sustain it. So instead of buying pounds, the market sold even more. The price barely moved. It stayed glued to the bottom. George Soros in New York saw the rate hike and smiled. He knew he had won. When a government does something that's desperate and the market ignores it, the game is over. He told Druckenmiller to keep selling. Let that sink in. The Bank of England, the institution that had financed the defeat of Napoleon, had just played its ace, and the market didn't even blink. Inside Downing Street, Prime Minister John Major was watching his career disintegrate in real time. He was the man who had staked everything on the exchange rate mechanism. He had promised the British people that the pound was safe. Now he was watching the wealth of the nation flow out the door into the pockets of hedge fund managers. The phone lines between Downing Street, the Treasury, and the Bank of England were on fire. They were running out of options. They were running out of money. They had spent billions in just a few hours. At this point, the British government resembled a crew on a sinking ship throwing furniture overboard to stay afloat. They considered suspending trading. They considered closing the banks. But that would destroy London's reputation as a financial center. They had one card left, the nuclear option. They would raise interest rates again. At 2:15 in the afternoon, the Bank of England announced a second rate hike. They raised rates from 12% to 15%. 15%. It was a number that struck terror into every British citizen with a mortgage or loan. If that rate stuck, it would mean bankruptcy for millions. It was economic suicide dressed up as policy. It was a bluff so massive that the government hoped the market would just collapse from shock. But the market was relentless. But the government hoped the market would just collapse from shock. But the market was relentless. The traders knew it was a bluff. They knew John Major couldn't keep rates at 15% without his own party throwing him out of office. The sell orders kept coming. The pound kept falling. It was over. The Bank of England had spent billions. They had raised rates to insane levels, and the pound was still crashing. The might of the British Empire had been pitted against the cold logic of mathematics, and mathematics had won. As the afternoon wore on, the exhausted officials in the Treasury put down their phones. There was nothing left to do. They couldn't buy any more currency. They couldn't raise rates any higher. They had to surrender. The decision was made at a meeting in Admiralty House. John Major, Norman Lamont, and senior ministers gathered in silence. They agreed to suspend Britain's membership in the exchange rate mechanism. They would let the pound float, which meant they would let it crash. At 7:30 in the evening, Norman Lamont walked out of the Treasury to face a wall of cameras. He looked pale, broken. He read a short statement announcing that Britain was withdrawing from the exchange rate mechanism and that the rate hikes had been canceled. It was total humiliation. A nation brought to its knees by a spreadsheet. In New York, George Soros and his team stopped trading. They had started the day with a massive short position. As the pound crashed, they bought back the pounds they owed at a much lower price. The difference was their profit. When the dust settled, Soros had made over $1 billion in a single day. Other hedge funds made hundreds of millions. Paul Tudor Jones, Bruce Kovner. It was the biggest payday in Wall Street history. Soros became a celebrity overnight. The British tabloids called him the man who broke the Bank of England. They painted him as a villain, a foreign predator who had robbed the British people. But Soros was unrepentant. He argued that he had done nothing wrong. He was a market participant. He saw a price that was false, and he bet against it. He said the fault lay with politicians who tried to defy economic gravity. If they had devalued the pound sooner, they would have saved billions. In his view, he had performed necessary surgery. The surgery was brutal. But the patient was already dying. The aftermath of Black Wednesday rippled through British politics for decades. The Conservative Party never fully recovered. They had always been the party of sound money and economic competence. Now they were the party that got mugged by a hedge fund. John Major's authority was destroyed. He limped on as Prime Minister until 1997, but he was finished. The Labour Party, led by Tony Blair, won a landslide. The memory of Black Wednesday was a weapon Labour used for a generation. But here's the twist. Here's the part that almost no one talks about. In the days and weeks after Black Wednesday, the British economy didn't collapse. It boomed. Once Britain was out of the exchange rate mechanism, it was free. The government could finally cut interest rates. They fell from 15% down to 6% in a matter of months. This was oxygen for the economy. Homeowners could breathe, businesses could borrow. The lower pound made British exports cheap. Factories started selling more goods abroad. The economy began to grow at a rapid pace. Many economists now argue that Black Wednesday was actually White Wednesday. They say being forced out of the system was the best thing that could have happened. It saved Britain from a decade of stagnation. It proved that trying to chain your economy to someone else's is a fatal mistake. This realization shaped the future. In the late 1990s, when European nations were preparing to launch the euro, Britain stood apart. The trauma of Black Wednesday was still fresh. Politicians and the public looked at the euro and saw another trap. They remembered what happened when they lost control of their own interest rates. Because of George Soros, Britain decided not to join the euro. France, Germany, Italy, and Spain gave up their national currencies. Britain kept the pound. This decision has shaped the 21st century. If Britain had joined the euro, Brexit might never have happened. The UK would have been so deeply integrated that leaving would have been impossible. So in a strange way, Soros didn't just break a bank. He changed the destiny of a nation. He kept the pound alive by forcing it to die.